This is part 2 of my presentation on cash and receivables, and this covers factored receivables and notes receivable. First, we'll cover factoring. Now, there's two ways that receivables can be factored, and first of all, factoring means that if a company needs cash right away, what they'll do is turn around and sell those accounts receivable to another company, and the other company will give them their cash right away, but of course for a fee. So there's two ways that a company can do this if they want to sell their accounts receivable. First, they can do a sale without recourse. In that case, the buyer cannot ask the seller for more money if the accounts receivable are not all collected and the buyer assumes the risk of bad debt. The accounts receivable are removed from the seller's books. Now, both under GAAP and the international standard, it's treated the same way if it's sale without recourse. However, if sale is with recourse, i.e., the seller of the receivable assumes all the responsibility for bad debt. So under GAAP, the seller assumes the responsibility of bad debt and must record the estimated liability for bad debt. The accounts receivable are removed from the books. However, under the international standard, if the accounts receivable are sold to another company, they remain on the books and of the seller, and instead a liability is created for the factored amount. So we'll go through both of those methods. So our first example is without recourse. Now, a company transferred $100,000 of their accounts receivable without recourse. The buyer remitted 85% of the factored amount. When the accounts are paid, the buyer will remit the retained amount less 3% fee and we are going to assume in this case that the fair value of the 15% interest is $11,000, allowing for returns. So what are our journal entries? Well, the cash we receive is going to be $85,000. The receivable from the factor we expect to receive in the future is $11,000 minus the 3% that's going to be charged by the buyer. The buyer. And then loss on sale of receivables is always a plug. And then the accounts receivable, $100,000, are taken off the seller's books. Now let's see what it looks like if we have recourse. So same example, but we're saying it's with recourse, and the seller estimates a $5,000 recourse obligation. They're estimating that's how many of them may not be received. So here are the journal entries. The cash is still $85,000. The receivable from the factor is still $8,000. But now we have a recourse obligation we have to record of $5,000. We take our accounts receivable off the book, and the plug is going to be loss on sale of receivables, which now is $12,000 because of the recourse liability. Now, what does the same problem look like under the international standard? Again, we have 85% of the $100,000. We have a 3% fee, an estimated $11,000 for the remittance, and the seller estimates $5,000 recourse obligation. What are the journals? Well, the cash that the client is going to receive is going to actually be $85,000 minus the 3% times the $100,000. So they're only going to actually get $82,000. The finance charge expense is going to be $3,000. And the liability, which is the amount of that we're going to put on the books, is $85,000. So that's how we handle factoring, i.e. when a company needs their cash right away and they sell their accounts receivable. So again, under the international standard, if there's recourse, you have to treat this as a liability and you do not take the receivables off the books. Now let's take a look at notes receivable. Notes receivable. Interest accrues over time. Discounted note, interest deducted at the beginning, notes receivable minus the interest revenue. A zero interest note, the interest is implied. So let's take a look at some examples. So for the first one, we have a non-interest bearing notes receivable. On December 31st, rendered services 2017, agreed to pay $122,000, accepting $50,000 down, and then agreed to pay at the end of each year $30,000. And there is an implied or assumed interest rate of 12%. So now what we're going to do is we're going to look at what do those journals look like. Also, we're going to use the effective rate. So first, we have to determine how to book the initial transaction. We know that we received cash of $50,000. We know that the notes receivable are going to be $90,000. They told us in the problem that the service revenue is $122,050, which means that the plug is $17,945, which is the implied interest. And it's put on the books at discount on notes receivable. Now, if they hadn't given you that $122,055, instead what you would have done is you would have gone to a present value of an annuity, and you would look up 3 years at 12%, and you would take the $30,000 times the factor plus the down payment, and you would then have gotten the capitalized value of the services of $122,055. Now, the next thing you want to do, since we're using the effective rate, which means your interest revenue is going to be different every time you book it, what we have to do is an amortization table. Now, we always start with the net book value of the note, which is going to be the face $90,000 minus the discount. And then our first interest revenue is going to be, we're going to take that $72,055 times the 12%, and that tells us of that $30,000 in cash received, $86,646.60 is interest, and $21,353.40 goes against the principal. The second payment, again, we're going to take the 50. In this case, now we're going to take the $50,701, and we're going to take that times the 12% to get $6,084.19, and then in the third year, the balance is what we're going to do. So it's just going to be the balance. It's going to be the difference between the face of the note and the balance in the account. When you use the effective rate, remember the interest revenue will be different for each payment. All right, let's look at our journal entries using the effective rate. The cash would be $30,000 we'd receive, and notes receivable would go down by $30,000, and then we would book our interest revenue, which we got from our amortization table for year one. Then, again, for the second year, we would book the cash, reduce the receivable, and we would book our revenue again. And again, you notice it's at a different rate. And then in the last year, for the final payment, we'd book the payment, and we'd book our last interest revenue, which should zero out our discount on notes and the notes receivable. Now let's look at an example of a non-interest-bearing notes receivable. So here we have my company sells $850,000 worth of stock and accepts a $910 zero interest 3-month notes receivable. Assuming an effective rate of 10%, what are the journal entries? Again, we'd book the notes receivable. We'd book the discount on note. We would take the investment off the books at $850,000, and the difference would be a gain on sale of investment. Now, the last thing I want to cover is the difference between when you have a notes receivable versus a discounted note. The difference is a notes receivable, the interest is earned over time and the individual gets the face amount of the note. When you use a discounted note, the interest is taken out up front. So, in this case, we had a sale, 100,000. We sold it to him for 100,000, and in exchange, we got a 6-month, 12% note. So, at the point of sale, we do notes receivable and sales revenue. And then when the payment's received, and assuming we don't accrue it each month, at the end of 6 months, we record the 6,000 in interest revenue. Now, what does this look like if we had a discounted note, if this had been discounted? The notes receivable would still be 100,000, but the sale would be reduced by the interest, which we would call discount on notes receivable. Now, when the actual amount is paid, again, we're going to take the accounts receivable off the books. We're going to take the discount on note, and then we're going to book our interest revenue. That concludes my presentation for factoring and notes receivable. I hope that helps you with your homework.